Do you know what really caused the US stock market to crash and trigger circuit breakers back in 2020? Most people will tell you it was the pandemic. They say that because everyone was locked down, unable to spend money or run businesses, the economy collapsed and the stock market followed suit. They believe that now that the pandemic is behind us, the crisis is solved and won't happen again. But if you look closer, you'll realize something strange. The 2020 crash only lasted about a month. Why? Because the Federal Reserve, led by Jerome Powell, opened the financial floodgates. They printed money without a ceiling and lent it to major institutions to pump the stock market back up. Does this mean we can conclude that even if another global crisis hits, we're safe from a financial collapse? Does it mean the worst we LL face is a 1-month dip because the Federal Reserve will just print our way out of it? Is that really the truth? Is the 2020 circuit breaker really just about a virus? And did printing money actually solve the problem? Or did it just kick the can down the road? Here's the reality. If a financial crisis explodes today, the damage, while painful, might be temporary. But if you delay that crisis, letting it fester and grow when it finally detonates, the devastation will be far worse, and the road to recovery will be incredibly long. Why are banks hoarding cash? Hello everyone, welcome to Stewardship Finance Academy. I'll be honest, creating this report gave me a heavy sense of responsibility. I don't want these predictions to come true, but I owe it to my audience to share what I see. I'm going to lay out the evidence for you. I'm not here to force you to believe me, but to explain why I have personally shifted my focus from the US stock market to hard assets like gold and silver over the last year. Right now, in 2026, we are seeing a disturbing trend. Major US banks are borrowing money at an alarming rate. We have seen periods where giants like JP Morgan Chase have borrowed billions in a single month. Morgan Stanley and Goldman Sachs have followed similar patterns, securing massive amounts of liquidity. We are talking about borrowing that rivals some of the most stressful periods in Wall Street history. In recent years, banks have utilized facilities like the Bank Term Funding Program, BTFP, to secure liquidity. And cash hoarding has been a noted trend during periods of uncertainty. The question you have to ask is, what are they doing with all this cash? The mystery of idle money. Take a look at the liquidity in the US market, what we might call idle money. Back in 2001, this idle cash sat at around $2 trillion. By the time of the 2020 crash, it had risen to $4.5 trillion. It took nearly 20 years for that number to grow by $2.5 trillion. But look at the surge from 2022 to today. Just a few short years, that number has skyrocketed. Some analysts argue this is normal. Say the Federal Reserve printed money in 2020. Of course there's more cash. That is truth, the Federal Reserve printed aggressively. But if you look at the data between 2020 and 2022, that liquidity line didn't shoot up immediately. Even during the 2008 financial crisis, when the printer was running hot, this idle money metric actually dipped. Why? Because typically, when new money enters the system, capitalists invest it or lend it out. They don't just let it sit there. Money that isn't moving is dead money. It's effectively frozen. But today, American bankers and capitalists are hoarding cash. They are borrowing at record levels, yet they aren't investing in new factories or lending to small businesses. Instead, they are parking this cash in piggy banks to earn safe interest places like short-term Treasury bills, interbank lending, and the Federal Reserve's overnight reverse repo facility. Why would someone borrow money just to let it sit? There are usually only 3 reasons. 1, they are desperate to survive. 2, they plan to take the money and run. 3, they are storing grain for a famine. They know a storm is coming, and they are preparing for the worst. History gives us a clue. Every time we see this massive accumulation of idle cash, it is followed by a gray zone on the charter crisis. 2000, 2008, 2020, every time capitalists start hoarding instead of spending, the crash follows. This time the hoarding is faster and larger than ever before. What do they see that we don't? Reports from the Federal Reserve have highlighted a concerning risk. A significant portion of the players amplifying these market risks are registered in offshore jurisdictions, like the Cayman Islands. The Cayman Islands is a major tax haven, but more importantly, it is often a regulatory blind spot. The US Securities and Exchange Commission SEC has limited reach there. We often don't know who the ultimate shareholders are or where the funds originate. Essentially, these actors operate in the shadows, leveraging global capital. If they win, they privatize the profits. If they lose, the global economy often bears the cost. And this time, regulators are struggling to keep up. Let's go back to 2020. Was the virus really the sole cause of the crash? Yes, the pandemic hurt physical businesses like restaurants and airlines. But if that was the only issue, shouldn't online businesses like Amazon or Netflix have skyrocketed immediately? Instead, initially, everything crashed. Good companies, bad companies, gold, Bitcoin, US Treasury debt didn't matter. Everything was sold off indiscriminately. If the problem was just the economy is bad, the government would have supported businesses. But the Federal Reserve's solution was a liquidity hose. It cured the market crash in a month, even though the real economy struggled for years. The Federal Reserve didn't fix the virus. They fixed the asset collapse. Why? Because the market had run out of money. It was a liquidity crisis. Everyone was scrambling for cash at any cost, the real culprit. The basis trade, so where did all the money go? Look at what the Federal Reserve bought to save the day. U.S. Treasuries bought trillions of dollars worth. They acted like a buyer of last resort, purchasing treasuries regardless of the price. Why? Because the U.S. Treasury market, the bedrock of the global financial system, was breaking. And the culprit was a strategy known as the basis trade. Let me explain the basis trade simply, using a rice shop analogy. Imagine you own a rice shop. A customer wants to buy rice from you 1 month from now. He is worried the price will skyrocket, so he signs a contract today to buy it at $101 next month. You, the shop owner, want to lock in a profit. So you go to the market today and buy the rice for $100. You spend $100 today spot price. You have a contract to sell it for $101 next month futures price. You lock in a risk-free $1 profit. This is arbitrage. You sell the future and buy the physical item to profit from the price difference. Wall Street funds do this with U.S. Treasuries. 1. They sell Treasury futures contracts promising to sell bonds later at a higher price. 2. They buy the actual U.S. Treasury bonds spot now. 3. They profit from the tiny price difference between the two. On its own, this trade only makes pennies. It's boring. But Wall Street doesn't do boring. The danger of leverage, since U.S. Treasuries are considered the safest asset on earth, safer than a house. Banks let these funds borrow massive amounts of money against them. These funds use leverage. They take their $100 of bonds, pledge them to a bank, borrow more money, buy more bonds, pledge those, and repeat. They might leverage their initial cash 50 or 100 times. Suddenly, that 5-cent profit becomes a $5 profit. If you have billions of dollars, you are making absolute fortunes risk-free until the music stops. In the years leading up to 2020, the Federal Reserve was tightening the money supply. Cash became scarce. When the pandemic hit, panic set in. Banks stopped lending. These hedge funds, sitting on massive piles of leveraged treasuries, suddenly needed cash. But the price of treasuries started to drop. If you have $10 billion of your own money, but own $1 trillion in bonds, a mere 5% drop wipes out $50 billion. You are technically bankrupt. Banks issued margin calls. Pay us or we sell your bonds. The funds didn't have the cash, so they had to sell everything stocks, gold, Bitcoin, just to survive. That is why everything crashed in 2020. It wasn't just the virus. It was highly leveraged funds blowing up and scrambling for dollars. The dash for cash in March 2020 was exacerbated by the unwinding of relative value hedge fund trades. Specifically, the Treasury basis trade. The moral hazard now, here's the most important part. Who paid the price? Not the funds. The Federal Reserve stepped in. They printed trillions to buy those bonds, effectively bailing out the gamblers. They even introduced super health packs for the market. Unlimited reverse repo, giving banks a place to park unlimited cash. Zero interest rates, making borrowing free again. The standing repo facility, SRF, a permanent safety net ensuring that if funds run out of cash again, the Fed will be there to swap their bonds for fresh dollars. The message to Wall Street was clear. The only bug in the game running out of cash has been fixed. The situation in 2026, so what happened next? Did they learn their lesson? No, because the Federal Reserve bailed them out. The risk was removed. And because the gap between futures and spot prices widened during the chaos, the trade became even more profitable. Charts show that the volume of this trade dropped after 2020, but has since roared back. By 2025 and entering 2026, the scale of these trades is estimated to be double what it was in 2020. Recent reports have indicated that hedge funds short positions in Treasury futures, a proxy for the basis trade, reached record highs in 2026. We are seeing a cycle where failure is rewarded. When these funds win, they keep the billions. When they lose, the central bank prints money, diluting your savings and causing inflation to save them. And this time, the risk is concentrated offshore. Data suggests that entities in the Cayman Islands have been massive net buyers of U.S. Treasuries, rivaling the holdings of major central banks. We are sitting on a bubble that is twice the size of 2020. Major banks and investors like Warren Buffett have been building massive cash piles because they know the system is fragile. They are building their shelters. Warren Buffett's Berkshire Hathaway reached record cash levels, signaling caution in the market. What should you do? The Federal Reserve can print money, but they cannot print value. When they bail out the system, the cost is transferred to you through inflation and currency devaluation. You need to ask yourself, in this era of volatility, what are the true assets? How do you protect the wealth you have worked so hard to build? We are not just predicting the future, we are preparing for it. Our team has developed a system designed to navigate these trends, not just to survive, but to thrive when the market shifts. In 2026, I am offering a special free session in our Stock Investment Masterclass. We dive deep into these mechanics and show you how to build a portfolio that can weather the storm. If you want to understand how to position yourself before the next liquidity crunch, click the link in the description. I don't ask you to blindly believe me. I ask you to look at the evidence. We're standing on thin ice, and the cracks are getting wider. I wish all of you financial safety and freedom. If you found value in this, please share it. Let's get ready together. See you in the next video.